On July 24th, FMCG giant ITC announced that it had received in-principle approval from the board of directors to demerge its hotel business. The new entity, called ITC Hotels Limited, will be incorporated as a wholly owned subsidiary of ITC Limited. While the conglomerate will hold a 40% stake in it, the company's shareholders will directly hold the remaining 60% proportionate to their shareholding. The demerger will take place under a scheme of arrangement, which shall be placed for approval before the board at its next meeting on August 14th. ITC runs 120 hotels in India, but the hospitality sector accounted for just 4% of ITC's revenue and 2% of its earnings before interest and tax in FY23. However, it accounted for about 11% of capital expenditure during the same period. The initial assessment by experts and media reports has been that ITC will see strengthened finances and improved capital allocation as a result of the demerger. For the full FY23 period, ITC's revenues were up by about 17% at about 76,500 crore rupees, while net profit was up by about 26% at about 19,190 crore. And ITC's fourth quarter year-on-year jump in consolidated net profit was led by growth across the cigarettes, FMCG and hotels segments. In hotels, the performance of the company, led by Chairman and Managing Director Sanjeev Puri, was backed by a focus on premiumization, cost optimization and an asset-right strategy. And the hospitality segment saw a stellar recovery, with pre-tax profits at over 200 crore rupees in Q4 FY23, compared with a loss of almost 30 crores in the year-ago period. And in a coincidence of sorts, on July 24th, the day the demerger announcement was made, ITC surpassed Hindustan Unilever to become India's most valuable, fast-moving consumer goods stock after a gap of over 4 years. For its part, ITC has said the demerger will attract investors and strategic partners that are aligned more sharply with the hospitality industry to its new hotels entity. The company adds that it will unlock the value of the hotels business for shareholders. The proposed demerger of its hotel business could reduce ITC's capital expenditure burden. In a report on 25th July, analysts at Nomura Financial Advisory and Securities India said the demerger would free up earmarked annual capex of about 200 crore to 300 crore rupees for ITC. They added that the demerger could also lead to surplus cash saving, along with higher dividend payout to shareholders in the medium term. Overall, analysts believe that the demerger will boost ITC's capital efficiency ratios and return on capital, with one IIFL analyst saying that the former will go up by almost 20 percentage points. However, the immediate reaction from investors was not encouraging. Shares of the conglomerate declined nearly 6% in 2 days after the management announced the demerger plan. However, they bounced back on July 26th, rising 2% to 470 rupees level. According to Nomura analysts, investors are worried that it is not a clean demerger and that value unlocking could be hampered potentially. Against this backdrop, what do experts think the proposed demerger means for ITC and shareholders?
ITC market cap is close to about 6 lakh crores. And ITC Hotels, the demerged entity, is expected to have a market cap of about 25,000 crores. So, which actually means that we are talking of about 3.5% to 4% of the ITC market cap. So, actually, this should not really move the needle for the shareholders. Looking at the structure which has been announced by ITC, that 40% will be held by ITC and 60% will be given to the shareholders, which actually means 15,000 crores worth of equity would be given to shareholders. And mind you, this is less than the dividend they paid last year. Last year, they paid about 18,000 crores as dividend. So, like I said, it should not move the needle. But overall, it should be sentimentally be positive.
The initial reaction in the share price was just a temporary reaction. And the ITC share, because of its basic value and its very high quality of management and governance, will come riding back. The profitability of ITC standalone without the hotels will rise compared to this year, quite obviously. There has never been a better time for hotels than it is today. India is on an absolute upsurge. Inbound tourism has gone up tremendously, and Indians themselves are holidaying like never before. And therefore, this could not have come at a better time. I actually see a fantastic value in this whole demerger. I'm actually very bullish about it.
One area that is being viewed with concern is how the new hotel entity's capital expenditure will be funded after the proposed demerger. So, what are the challenges for ITC going ahead?
No, I don't really see any major challenges as such. Once it's demerged, ITC hotels will have to manage their capex on their own. And it will free up a decent amount of cash for ITC as such, which can be put in the other verticals which they have, especially retail, which still guzzles cash as such. Looking at the hotels, the future business is going to be more of asset light. So I really don't see too much of a capex requirement by ITC hotels, and whatever they require, I think they'll manage on their own.
Experts don't see any specific challenges emerging from the proposed demerger and view it as a positive development for ITC overall and its hotels business in particular. However, lingering investor concerns around the proposed structure post-demerger should be addressed.
If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.
He's making plans for an early retirement. Business Standard.